on Facebook and the YouTube with another lesson in personal finance. I'm Jim Munchback, and I'm welcoming my students from the University of Houston at the Bauer College of Business. We have some folks live in the Zoom room, and probably we will have some more as we get going. It's summer, which means we go really fast, and we're getting close to the end of the semester. In fact, I was going to spend a minute and just kind of look at the syllabus. So today we're going to do the title of the lesson is called the Enron Investors, but we're really focusing on types of accounts, and it's tax advantaged investing is really what it is. So I'm going to go over some of the your homework assignment, what you will do in your financial plan to update your financial plan with regard to some of the things we're going to talk about today. I've got students coming on board, and we are early, so I'm not really getting started. I just wanted to take a peek at the syllabus, which is what I'm doing now, just to kind of get in my mind, really clear about what we have coming. Because it is summer school, it's always a little challenging for me because we go so fast, and it's kind of an abbreviated semester. As much as I wish we had more time, I know you're all busy, and so am I, and we just pack it all into a shorter time frame. So for that reason, I do my best to try to cover everything, but we do always have a bit of a challenge in summer school. So I hope you guys are feeling like you're getting your money's worth in terms of this course. I hope that you're feeling confident about getting enough points to get your A, because I know that as much as I'm passionate about teaching you how to become a millionaire by the time you're 50, I know that you're passionate about getting an A and graduating on time. And that's awesome. And I want to help you do that. So most of you are doing an awesome job. One of the things that I've discovered in summer school is we have a very small number of students who join us in the Zoom meeting live, which is fine. It's an asynchronous course, so that's certainly not required. This will get posted, this video, this recording, this live stream will get posted in your playlist for Money Study Group. So I'll do that as soon as we end, and that's where most people watch. Most people hopefully watch. But I wanted to say you guys are doing a great job. As I'm grading your assignments, I'm finding just an outstanding level of quality in your work, and so I'm thankful for that. It makes my job easy. It also makes me feel like, or think, or believe, or perceive that you guys are getting the process of building a financial plan using your Bayrock portal, and that's encouraging to me. So I wanted to mention before I just really get started, it's only 10:01 a.m., so I'm a little early, and so are you, and I appreciate that. But I did want to mention that, it is my hope, it's my goal, it's my intention, it's really something that's important to me to help you create a financial plan that you can use moving forward in your life as you graduate, as you get a job, as you start to build wealth for the future. It's my hope that I can be a resource to you. So while this course is, it's always changing and improving, and hopefully it's improving, it really is an introduction to personal finance. And so because of that, I want to make sure you know that your financial planning portal will be available to you for as long as you want to keep that. And if you're active in it, I'll leave you there, and I'll be available to answer questions later on down the road when you have more time and more focus on really getting your financial plan updated and workable for you. So hopefully this course has given you a really good grasp of what's possible with a financial plan and the tools that we use to create a financial plan. And so I just want to let you know, in the context of helping you get your money's worth for this course, it's something that I feel good about making available to you after the course, long after the course. So just wanted to let you know about that. So let me just go over, it's still a little early, but I want to, for those of you who are here and those of you who might watch later as we record this. So we've got this assignment, which is lesson number 10. We're going to talk about types of accounts, which falls under the idea of tax-advantaged investing. So your homework assignment from this lesson is going to be to learn about these different types of accounts that I'll talk about today, and then to go ahead and update your financial plan and allocate some of your investments into these types of accounts. So that'll make more sense as we get through the lesson, but that'll be your homework assignment. And then next week we have really it's kind of an extension. So you're going to spend a couple of weeks working on updating your financial plan with what you learned today, what you will learn today, and what you learned last week about the investment strategies. So I'm going to spend a few minutes and just review the investment strategies we talked about last week. And then this week's assignment and this week's lesson is going to be, I call it buckets. So I'm going to use these buckets, which I will show you, to illustrate types of accounts. So it is still a little early. We have a minute before I really want to get started, but for those of you who are here, I kind of wanted to do a bit of an intro. So that's what we're going to do today. You know, it's 10:05, so it's time to get started officially. If anyone joins later, typically I just don't let them in. So I know you know that because you guys have been here on time, ready to go every week, and I appreciate that for the most part. There's some regulars that I don't see, and I miss you, but I see some regulars, Thomas and Rehan and Mandy and Yen. It's good to see you guys. So here we go. We're going to talk about buckets. And I use this bucket illustration just because it makes sense to me. And so I'm going to jump right in and I'm going to show you the first image is this big blue bucket. It's a it's a non-tax qualified bucket. And I'm going to come back to that. But I want you to know inside of that big blue bucket, there are 3 other buckets. And so we're going to go over those buckets and I'm going to illustrate different types of accounts. But before I do that, I want to jump back into the last week's lesson and I want to review the investment strategies we discussed, starting with what I called the perfect investment. So if you're watching on YouTube or Facebook and you want to leave a comment and just tell me what is the perfect investment that we discussed last week. I try to go over this multiple times throughout the semester because, in my opinion, one of the most important things you can do for yourself, whether you're a student at the Bauer College of Business taking personal finance or someone who's been working for a few years or even someone who's thinking about retiring, if you haven't already taken advantage of the perfect investment, you're really missing out on an opportunity to move the needle in a considerable way in terms of building wealth. And so I want to spend just a minute to talk about the perfect investment. And if you're in the Zoom room, if you could just leave a chat and kind of tell me if you recall what is what I described as the perfect investment. So I'm going to give you just a minute to think about that, to remember our lesson from last week as we talked about the investment strategies. I introduced the 4 investment strategies with the idea of the perfect investment. And so I'll just touch on the 4 investment strategies while you're thinking about the perfect investment. Let that simmer in the back of your mind. What is the perfect investment? And so the 4 investment strategies that we discussed were diversification. Oh, there's the perfect investment. I'm not going to, if you go to Missional Money, by the way, you can go to missionalmoney.com. That's where this post is, and it tells you all about the perfect investment, but I'm hiding that from you for the moment. Yes, Yen, you got it right. And everyone who's in the chat room and the Zoom room can see that it's the 401k match. That's what I consider to be the perfect investment. And so I taught you 4 investment strategies last week that are designed to help you maximize returns and minimize risk, to really help you build wealth. And these 4 investment strategies specifically are for you. In other words, there are lots and lots of investment strategies. And if you were me, if you were 60 years old and you'd already accumulated some wealth, I would be talking to you about very different investment strategies, because in different stages of life, you need different strategies. And so my investment strategies, the ones that I use for myself, are very, very different than the 4 investment. Uh-oh, Siri thinks I'm talking to her. Sorry about that. She thinks I'm searching. I don't even know where she came from, but she does that every once in a while. Sorry. And I get distracted when that happens. So the 4 investment strategies that we outlined, they're designed for you because they're really effective for young people with a lot of time to invest. And so some of them apply to everyone. I'll go over them really quickly. The first one was simply diversification. And I talked to you a little bit about, I told this story about Enron and 2 clients that I had who, well, one of them was a client, one of them was not a client. She was just a person who had experienced the terrible results of Enron. And so I told 2 stories. So you may want to go back and listen to that. If you don't remember Enron, you might want to do a little research and just make sure you're familiar with the story of Enron. And it's the story that I always tell to help people appreciate the importance of diversification, not putting all your eggs in one basket. It's a fundamental, probably the most essential investment strategy. It's very, very simple, but it is important, and that's why it's one of the 4 that made the top 4 list. The second one is what I consider to be, well, not just me, but anyone in my business, anyone who is a professional money manager, an investment advisor, knows that the most important determinant of your portfolio's results is asset allocation. So diversification just means don't put all your eggs in one basket. Asset allocation is more complex than diversification. It means that you've taken the time to look at different asset classes and allocate your portfolio, the investments in your portfolio, in different asset classes. And so you did a little work, a little research, a little study to understand different asset classes. And that's really important. You can't really take advantage of these investment strategies if you're clueless about asset classes. And so all of this fits into a very helpful kind of schematic or blueprint or roadmap when you think about the perfect investment. If you are going to invest in a 401k, and we use the example of Shell Oil, and I think I said they were matching 8%, and the illustration was you're making $100,000 a year and you're contributing in order to receive that match, you're going to need to contribute $8,000 a year, because 8% of 100,000 is $8,000. And we said that Shell, your employer, would match that 8%. Now it's a pretty optimistic number. I don't think Shell actually matches 8%, but I wanted to make the illustration I wanted to make it clear and impactful. So that was the number. $8,000 is how much you would need to contribute in order to receive the match, because you make $100,000. And so the perfect investment, in my opinion, what I told you, what I'm telling you again, is that if you invest in that 401k, if you put money out of your paycheck every time you get paid into the 401k, on day one, when you sign up for your benefits at your employer, you want to say, yes, I'm going to participate in the 401k. And how much are you going to put into your 401k account? And the answer to that was, well, how much is the match? How much do I make? You got to do a little math, and you got to figure out, okay, how much do I need to have deducted from my paycheck to go into my 401k account in order to make sure that I get the full match. So you can do the math. It's going to be different based on how much you make and how much your company matches. But in this example, we made it super simple. You make 100 grand. They match 8%. That means $8,000 a year. So you divide that $8,000 a year by the number of paychecks that you get. If it's 52, if you get paid every week or every other week, you just have to do a little math. And that's how much that gets deducted from your paycheck every time you get paid. And that goes into your 401k. And the beautiful thing about that is if you set up your 401k with a little bit of attention to asset allocation, then you're taking full advantage of the first two investment strategies that are really important. The first one's diversification. And I told you last week that if you do asset allocation, if you attend to that strategy, you're automatically diversified, because you can't have good asset allocation and not be diversified. So the first one, diversification, is super simple. The second one is a little bit more tricky, but it's more important, and it, again, helps you achieve the first one, diversification, automatically. The third, Thomas, never forget Enron. So the third investment strategy that I mentioned, that I said was, in my opinion, the most powerful investment strategy for someone in your situation, a younger person with lots of years to invest, with a lot of market ups and downs over your investing career. Dollar cost averaging is the most powerful investment strategy designed to help you maximize returns and minimize risk over time. It's the most powerful investment strategy because if you start with just decent asset allocation, and you do what I just said with your 401k, and you're putting it in systematically, paycheck by paycheck, you're automatically taking advantage of the first three investment strategies. You're diversified because you have good asset allocation, which could be as simple as 25% in large cap U.S. stocks, 25% in small cap stocks, 25% in international stocks, and 25% in U.S. government bonds. I mean, that's just one very super simple example of asset allocation with 25% in each of those different asset classes. Your 401k, your company, will have different options. Every company has different options, and they're usually kind of limited. And so you have to look at your options to see what are the best options. But you get the idea. It's really just picking different asset classes and then looking at the options that you have to select how you're going to allocate your investments in your 401k. So that's asset allocation. But dollar cost averaging, remember, we talked about Farmer Joe. Remember Farmer Joe? And he bought cows. And remember how he started buying cows and they were $100 a head, and he had determined that he was going to put $100 a month investing systematically into cows. And then every month cows kept going down until they were $20 a head. And he was able to buy 5 cows that month, right? I think that's right. And over 7 months, he purchased 19 cows, and he never spent over $100 a head, but he got some months where he was getting multiple cows for the same amount of money, which is exactly what happens in your 401k when you set it up you take out every time you get paid, you're buying those different asset classes. Sometimes they're higher and you buy fewer of them. And that helps prevent you from putting too much money in when those asset classes are too high, just like the cows. And sometimes those asset classes are in the commode or in the basement. They're at a big discount, like Joe's cows were when they were $20 a head, which allows you to buy more of them. And so over time, dollar cost averaging is, trust me, the most powerful investment strategy available to you. And no matter what the market does, if it's going up or down, dollar cost averaging has a way of helping you maximize returns and minimize risk. And over time, it's the most powerful strategy for building wealth. And so it's perfect for your 401k because it's like automatic. So that was the third investment strategy I wanted you to be aware of. And then the fourth one, thanks, Rehan. I love that strategy too. Don't use it for crypto and Bitcoin, but that would be a great way to do dollar cost averaging, because imagine if you bought Bitcoin when it was like, was it 50 grand for a Bitcoin? Something, it was crazy high. And then recently with inflation and lots of uncertainty in the market, I think it dropped to like 19,000. Maybe it was some crypto. I'm not big into crypto, but I know that market, like any asset class, and I would consider crypto a very innovative asset class, it had serious volatility. And so those are the kind of asset classes that you want to use dollar cost averaging, because over time you're going to be getting the benefit of buying those assets at lower prices. And when they're high, if you're buying them when they're high, you're buying fewer of them, but you're only committing that portion of your asset allocation that is attributable to that asset class. So you see how that works. Just think about it, get familiar with it, because again, it is the most powerful investment strategy available to you if you're a young investor with a long time horizon. If you want to build wealth, if you want to maximize returns and minimize risk, it is the best strategy combined with asset allocation. So then the final fourth investment strategy was portfolio rebalancing. And remember that super simple illustration I gave you for asset allocation with 25% in 4 different asset classes. And over time, let's assume that pizza with 4 pieces still has 4 pieces, but one of the pieces of pizza is like as big as half the pizza. And then one of those pieces is the little sliver of a piece of pizza, because that asset class went down, 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 while the other asset class that makes up half of your pizza pie now, it just exploded to the upside. So portfolio rebalancing says, okay, let's sell that big fat inflated piece of your portfolio. Let's sell some of that off and buy some more of that little sliver that has deflated or gone down. Let's buy some more of that. Let's put it back in balance. And so you use that strategy every quarter, every 6 months, once a year. But on a regular basis, you go and you rebalance your portfolio. It's like using dollar cost averaging, but in a little bit different way. So those are the 4 investment strategies that I hope you will take some time, not just to be familiar with, but to recognize that you're able to put these strategies into practice in your 401k. And if you will just let that simmer in your mind for the next couple of years, you will become, how can I say this? I would say you will become a more proficient investor than most of the people you know. And if you understand these 4 strategies and you put them into practice and you understand how they work, you will find that when you watch the news and you listen to people who are supposed to be very, very smart about investing, you will begin to discover, like I've discovered after working on Wall Street as an investment advisor for big banks like Morgan Stanley and the wealth management department, you will learn like I learned, they're clueless. They're not giving you good advice at all. In fact, nothing they say is remotely valuable to you. It's just noise. That's all it is noise. They make noise on the news when they talk about financial stuff like the markets, just to get you to watch and listen. And then they want you to think they're really smart so that you will click on their link and hire them to be your advisor or whatever. But nobody has a clue. I'm telling you, these strategies work, and they work like money, and money works in a certain way. So if you just put them into practice and get to know them, get familiar with them, you will find that you really are smart enough to do this yourself. And then once you have a significant amount of money and you need some different strategies, that's when it makes sense to consider having an advisor who maybe has some more tools available. But that's not a commercial. That's just the truth. So here we go. Hopefully now with the perfect investment, that's kind of got to be the foundation, I think, for you. Because if you do one thing, actually there'd be two things I would want you to do. If you take this course and you walk away and you forget everything you learned, but there's two things I hope you will do. One is, I hope you will continue to be accountable for your money. Like, where does it go? How do you keep track of where your money goes? That's really important, and most people don't do it. It is the single most important discipline in managing money. And if you just do that, you'll be way ahead of the game. But number two is, I hope you will set up your 401k and take advantage of the perfect investment, because just doing those two things, I promise you, will make this course pay dividends forever in your financial future. So today we're going to talk about types of accounts. Most people, when you hear someone talk about a Roth IRA or a 401k or their tax deductible IRA, when you hear those terms, a lot of times people will say, I have investments. I have an investment. It's my 401k or my Roth IRA. And technically, those are not investments. They're types of accounts. And so when we talk about investing, when we talk about tax-advantaged investing, it's all about putting your money in the right types of accounts. So I want you to understand a few basic distinctions about types of accounts. And that's what this lesson is about. And your homework assignment, by the way, is going to be to go into your financial plan, and not only do you need to allocate your asset classes, but you need to allocate your investments according to taxable versus tax advantaged. So to do that, you just go into your plan and you say, okay, I'm going to invest this much of my money into my 401k, this much into my IRA, and this much into my Roth IRA. And so let's talk about what you're going to learn this week as you do your homework assignment. You're going to learn about those types of accounts. I'm just going to give you a quick illustration to help you understand and be able to distinguish between the types of accounts. But you got to go do a little research on your own so that you can understand what are the rules, boundaries, and limitations for each of these different types of accounts. So it starts with this big blue bucket. And the big blue bucket, to me, represents, and by the way, inside of that bucket, there are 3 other buckets. And so we're going to talk about those buckets. And you're going to see that pink shovel, which I'll talk about in a bit. But this big blue bucket, and it's an unlimited size, okay? It represents a non-tax qualified account. So everything you own could go into this blue bucket: your home, your motorcycle, your car, your Rolex watch, your baseball cards that you've been collecting, your jewelry, whatever you own, everything you own. Imagine that it could go in this big blue bucket. There are no tax benefits. There's no special protection. The cash under your bed, the checking account at the bank. Oh, if it's at the bank, though, it does have a little protection because you have FDIC insurance, but it doesn't have any tax benefits. And that's kind of the point here, is this big blue bucket, you can fill it up with billions and billions and billions of dollars and stuff. And those assets have no benefit, no tax benefit, which means you're going to pay taxes on those assets at some point. And that's why it's plastic. That's why this big blue bucket that I'm using to illustrate the non-taxable account is plastic, because it's not a tax qualified account. And so it helps us distinguish between different types of accounts that are tax qualified, which means they have certain tax benefits, tax advantages. So this one, the blue one, the big blue one, there's no limits. You can put as much in this type of account as you want. You can even have, you may have heard of margin. So I have one of these accounts. It's actually the one I do the most investment trading in, because in that account, I can do things like in my brokerage account, which is a non-taxable account, non-tax qualified account. It's like this big blue bucket. It's at Charles Schwab, and I set up an account, I put it in my name. I don't get any tax benefits, but I have things like margin. So in other words, I can set that account up so that if I want to buy Apple stock and I only have $100,000 in my account, but I want to buy $150,000 of Apple stock, I can do that, because not Morgan Stanley, but Charles Schwab will give me margin, which basically means they're going to let me borrow money from them. I'll have to pay an interest rate for my margin because I'm buying Apple stock on margin. Very risky, very dumb. I wouldn't do that, but I do have margin in my account, because sometimes I like to sell Apple stock short. And if you sell a stock short, you have pretty much unlimited risk, and so you have to have margin in that account. So that's way inside baseball, but it does illustrate there are some benefits to this non-tax qualified account, because you can do some things in this one that you can't do in the tax qualified accounts. But just think of the big blue bucket as unlimited. You can have as much stuff, as many assets in there as possible as you want, and you don't get any tax benefit. You're going to pay taxes on all of it. So that's the big blue bucket. It's a non-taxable bucket. And then you've got the pink shovel. I'll come back to the pink shovel later. Next, we have the big brown bucket. So the big brown bucket is an important bucket. This is what illustrates or represents your 401k, your company 401k plan. It's big. It's a big brown bucket, because that's typically an account that is relatively bigger for people. But imagine if you work for 20 or 30 years for Shell or for any company. Your 401k allows you to contribute quite a bit of money, and then you get that company match in addition. And so this type of account, the 401k, it can really grow to be a substantial amount of money for your retirement savings. And that's why it's a big brown bucket. And it's metal because it has much better protection for you than the big plastic blue bucket. So this represents your 401k. Now I want to mention, and you'll do a little research this week to learn more about the 401k type of account and the big brown bucket. But this big brown bucket illustrates the company retirement plan. So if you work for a corporation, we call that a 401k. And the reason it's a 401k is because the 401k is the title for the paragraph in the tax code. That's all it is. But in that particular paragraph, 401k, in that paragraph, it outlines all, it's not a paragraph, it's pages. There are multiple paragraphs, but the header, that section of the IRS code, 401k, has all the rules, boundaries, and limitations related to this type of account. So it's a 401k, that's what we call it, because that's the title according to the IRS code, okay? But there are other types of accounts that are very, very similar to this. For example, let's say you're a teacher or you work for a nonprofit, then you would use what's called a 403b, different paragraph in the IRS code, basically the same bucket. It's just if you work for a nonprofit instead of a 401k, which is a corporation, you would have access typically to a 403b. And if you worked for the government, I think that's a 451, I forget, but it's a different paragraph, a different header in the IRS code, but it's the same basic account. The main idea here is that you get to put a considerable amount of your income into this bucket, and you get a tax deduction when you do it. Now, the 401k is typically, I think it's the only one of these kinds of buckets, the big brown bucket, that allows you to get a company match. So if you work for a corporation, for-profit corporation, they offer that match in their 401k as a way to entice you to come to work for them. It's a competition thing. It's something that gives them an edge over their competition. The better their benefits package, the more they can attract better quality employees. And so the 401k is a little bit different than a 403b. I don't know any 403b plans where they match for teachers or nonprofits, people that work at churches and so on. That 403b plan isn't quite as good as a 401k plan, but it's the same bucket, the same type of account. And that's what I'm trying to illustrate is this big brown bucket is an example of your 401k, your company retirement plan, whether you work for the government or a school or a nonprofit or a corporation. The big brown bucket is what I'm using to illustrate that. So I hope that makes sense, because it's an important part of your financial future. It's an important part of your financial plan. Next, we have what I call the medium metal bucket, and this represents a tax deductible IRA. I don't know if you know what IRA stands for, but if you do, post that in the comments. What does IRA stand for? Most people would say, and I'm going to pause to see if I get any comments from my folks in the Zoom room, because that's where I'm seeing the chat box at the moment. What does IRA stand for? I'll tell you what most people think it stands for as I'm waiting for a comment. I don't see any comments. IRA. Most people think, I know you're Googling it now, and you're going to have the answer by the time I say what most people say, but an IRA, most people say it's an individual retirement account, and that's fine. I'm okay with that. I think that's what I think of with an IRA. In fact, I often say it's an individual retirement account, but the truth is it's actually technically an individual retirement arrangement. So it is what it is, but this bucket is what I use to illustrate the tax deductible IRA, and it's a very important bucket. And so I want to help you understand that it works very similar to that brown bucket. When you put money into this medium metal bucket, you get to deduct. You can deduct the amount you put in there. There's a different limit. The amount that you can put into this bucket is much, much lower than what you can put into the big brown bucket. But as an investor, if you have earned income, you can actually put money into this bucket and get a deduction because it's a tax deductible IRA. Another important feature of this bucket is if you leave your employer, whether you work for the government, a charity, or a corporation that has a 401k, the government plan is 457, I think, and the 403b is for the nonprofits and the teachers. But whenever you leave any of those employers, you are no longer able to fund that brown bucket at the company you worked for, the organization you worked for. And so you have to do something with the money that you put in that account. And so that's where this bucket comes in. One of the major features of this bucket is that it will receive the rollover. We call it a 401k rollover, whether it's a 401k or a 403b or a 457. If it's that brown bucket type of account, when you leave the employment of that organization, you need to typically roll over your money, and you have to set up a tax deductible IRA, and that's where you roll the money, you roll the funds into that type of account. So now, if you have an IRA, now you have the challenge of managing the investments in that IRA, the money that you'd saved when you worked at your employer with that organization, the money you put into that big brown bucket now gets transferred or rolled over into this IRA bucket. So those are the two things I want you to know about this type of bucket, the tax deductible IRA. It's the bucket that receives the funds when you leave employment from a company that offered a 401k or a 457 or a 403b or any of those company retirement accounts that allow you to contribute a lot of money. So then you can roll it over into your IRA, your tax deductible IRA. So that's what that bucket is, the medium metal bucket. So now we've covered 3 buckets. We've covered the big blue bucket, which has no tax benefits. It's just the big taxable blue bucket. And then we covered the brown bucket, the IRA, the company plan. And then we covered the metal bucket. So those are the 3 buckets. So let me just mention about the big blue bucket. Let's rewind the clock for a minute. And let's say that it's 2009. I remember 2009, we'd just gone through, or we were going through, the great financial crisis. And my friend Adam and I, we were both interested in investing, looking for opportunities, and we wanted to invest in Apple stock. But it was trading at $125 a share. And we were both pretty sure it was going to go down back in 2009. Now, I'm just going to open up, see what Apple stock is trading for today. So think about for a minute. Let me find Apple stock if I can. Here's Apple. So this is Apple stock. It's trading at $147.50, it looks like. And it's actually looks like it's up a little today. But Apple stock was trading at $125. Oh, go away. Advertisements. Sorry about that. It was trading at $125. So if you would have had a blue bucket and you would have invested in Apple stock, let's say you had $100,000 and you wanted to buy Apple stock, or let's say you had $125,000, you could buy how many shares of Apple stock? If it was $125 a share, you could buy 1,000 shares, right? If you had $125,000, yeah, you could buy 1,000 shares, because 1,000 times 125 is 125,000. So you might look at that chart and say, oh, cool. So Apple stock would be, instead of $125 a share, it's 147, which means your $100,000 would be $147,000, but you'd be very, very wrong. Does anybody know why you'd be very, very wrong? The value of Apple stock at $125 a share back in 2009 has changed dramatically. And what happened is Apple, just like Amazon did recently, they split their stock. So Amazon recently did a 20-for-1 split, which means if you owned 1 share of Amazon stock 3 weeks ago, today you would own 20 shares. So Apple has done that like 3 times. I can't even, I forget the math, but you would have easily over $1 million. In fact, I think you'd have like $7 million if we would have invested 125 grand in Apple stock back in 2009. We would be very wealthy. My point is that if we had put that in this blue bucket, if that's where we invested our $125,000 in Apple stock and we owned 1,000 shares, and today we wanted to sell it, today we would have not 1,000 shares. We'd have somewhere around, I want to say 12,000 shares, but I'd have to go back and see how many times the stock split. And so at any rate, we would have a lot of shares of Apple stock, and it's trading at $147. So we would have a massive taxable gain if we sold it today. And that's the drawback of this big blue bucket, is if we would have done that, if we would have bought Apple stock in this big blue bucket and then sold it, we get to pay Uncle Sam a whole lot of tax because we had a huge taxable gain, capital gain. So that's the drawback of the big blue bucket. I guess maybe it's time to talk about the pink shovel. Is anybody curious about the pink shovel? Maybe I'll come back to the pink shovel. So back to the Apple illustration. I haven't gotten to this gold bucket yet, but the last bucket I want to talk about is this gold bucket. It's a tax-free bucket. It's the only bucket that's tax-free, by the way. So when we talk about tax-advantaged investing, so far we've only talked about the difference between taxable and tax deductible. So the big brown bucket and the IRA bucket, those are both tax deductible, which means they're tax deferred, which means you get a deduction when you put the money into those accounts, but then when you retire and you start taking money out, at that point, in those tax deferred types of accounts, you have to actually pay the income tax on the money that you take out. So now I'm 60 years old. If I had $1 million in my IRA and I decided I wanted to take out $100,000 today, and let's say I'm in a 24% tax bracket, or 35, let's say I'm a 35% tax bracket, and I want to take out $100,000 from my $1 million IRA. Remember, I got to use those, when I put money into those accounts, I got a tax deduction, which was really good because I made a pretty good amount of money back then. Today, I don't make quite as much money, so I'm at a lower tax bracket. So still, when I take money out of that account, I have to pay taxes. So that 100 grand that I took out of my IRA with a 35% tax bracket, I'm going to have to pay how much money in a 35% tax bracket on $100,000? I'm going to have to pay 35 grand. So if I would have bought $125,000 worth of Apple stock back in 2009, my IRA would be worth, let's say, $20 million. I mean, $10 million at least. It's actually like $11 million, as I recall. A lot of money. If I would have done that in my IRA, then I would have had to pay the taxes. As I took the money out, I would have to pay the taxes because that money was tax deferred. But think about that. I got a tax deduction to put money into that account, and then I bought Apple stock in that account, and I didn't have to pay any taxes on any of that until I take the money out, and then I have to pay tax on the amount that I take out. But I never had to pay taxes on the growth. It just sat there and grew. But that's a tax deductible, tax deferred type of account. In a Roth IRA, it's different. So in a Roth IRA, I don't get the tax deduction. So if I put money, and I do put money, instead of putting it in a tax deductible IRA, and if I did that, if I had accumulated $125,000 in my Roth IRA, I'm getting some, Yen, can you still hear me? I'm getting some feedback on my computer that we're having some problems. Okay, cool. I'm going to pretend everything's good and keep going. So back to the illustration, if I would have bought Apple stock with my Roth IRA back in 2009, and it would have grown to like $11 million. The beautiful thing about this type of account is I could take the money out now that I'm 60 years old. I have no penalty. If you take money out of your Roth IRA or your IRA before you're 59 and a half, you pay a 10% penalty. But because I'm 60, I don't have to worry about that penalty anymore. But I do have to pay the tax on the income if I take it out of my tax deductible IRA. But my Roth IRA, there is no tax at all. because I didn't get a tax deduction when I put the money into the account. So if I would have used that account to buy that Apple stock back in 2009, today I would have, let's say, $11 million in my Roth IRA, and I could take 100,000 or 200,000 or a million. I could take however much I want to take out of that Roth IRA account today, and I would pay no taxes. So think about that. You have the option. We all have the option. We can invest in a tax deductible IRA, and this is an option you have. You know, depending on how much you're contributing to your 401k, there's some rules that apply. But most people can contribute to a tax deductible IRA or a Roth IRA. You can contribute to both, but you have an annual limit on how much you can contribute. So you could say, I'm going to do half in this account and half in that account. But I put all of my annual contributions into my Roth IRA. And I just want you to know why this bucket's gold. The reason the small Roth IRA bucket is gold is because it's the it's the only tax-free type of account that is available. And that makes it very, very special. So the Roth IRA is a tax-free, it's tax advantaged, but it's unique, it's different, it's better, it's special. It's not like the tax deductible IRA. It's tax-free. You do not get a tax deduction when you put money into the account, but when you take the money out, you pay no taxes. So I want you to know about that type of account. There will be a quiz on these different types of accounts. So that's the tax-free account. Now let me talk a little bit about that pink shovel. I don't know if I don't think I told you this story, but when I was about 10 years old, I was a big kid, and I lived in Lansing, Michigan. My dad was in the military, and he left the military and went to work for Oldsmobile, General Motors. He worked in a plant. My mom didn't work. We had 5 kids in the family. At the time, when I was 10 years old, we had 4 kids. I had a brother that came along when I was 15 years old, but he doesn't count for this story. So just imagine we lived in this house, pretty small house, big yard, one income. My dad worked, my mom didn't. Lots of groceries, lots of expenses. And so we certainly didn't think we were poor, but frankly, we were probably kind of in the low income status. At any rate, at that time, we all got the same tennis shoes, and my mom bought the tennis shoes at Kmart. They were Converse tennis shoes. So think, if you don't know what a Converse, the brand name Converse tennis shoes, they were available when I was 10 years old. In fact, they made a canvas Converse tennis shoe, low top and high top, and they came in black or white. And you could buy those shoes at Kmart for $4 a pair, literally. And so everyone in my 2 brothers, I had a sister too, but the boys all got the same tennis shoes, and we got to choose if we wanted white or black. Okay, that was the option. But then when I was like 10 years old, Dr. J, Julius Erving, basketball hero of many young boys from back in the day, he came out and he endorsed Converse tennis shoes, and they were leather. And they made a leather high top Converse tennis shoe that was awesome. I mean, it was like the new thing. It was like the new iPhone today, maybe. But those tennis shoes were on sale at Kmart, but they were $10 a pair. And I really wanted a pair of those tennis shoes. So I went to my mom and I said, hey, Mom, instead of the canvas, low top, white or black, would you please, Mom, get me the leather high top? And my mom said, they're $10. No, I can't afford that. We can't afford that. No, I'm not going to do that. And of course, as a 10-year-old boy, I couldn't take no for an answer. I'm sure you've experienced this at some point in your life where you couldn't accept no for an answer. And so I went back to my mom and I begged her, and she said, like most moms back then, go ask your dad. That scared me because I knew dad's a little tougher than mom. And so I did. I went and asked dad. I said, hey, dad, look, all my friends are getting these tennis shoes and they're really cool. And I'd really like to get some, dad, please. And my dad kind of chuckled and he said, you know what? I can help you get those tennis shoes, but here's the deal. If you want those tennis shoes, you're going to have to come up with $6 because the difference in the price from 4 to 10 is $6. He said, I'll give you the $4 just like I would buy those tennis shoes, but you got to come up with a difference. I'm like, how am I going to do that, Dad? So my dad walked out to the shed and he got a snow shovel. He said, here. That's what the pink shovel stands for, a snow shovel. He said, here, you can borrow my snow shovel. You can't have it. If you break it, you have to replace it. But you can borrow my snow shovel. And it just so happened it was Saturday and it had snowed about a foot. And my dad said, here's the deal, son. Go knock on the neighbors' doors, like start with the Turners. They have a really nice yard with, they take good care of their grass in the summertime, and their driveway needs to be shoveled and their walkways need to be shoveled. Go knock on the door and ask them if they will pay you to shovel their snow. So I did, and they said yes, and they paid me $10. I couldn't believe it. But I didn't stop there. I went to the next neighbor and the next neighbor. And before I knew it, I had more neighbors wanting to pay me to shovel their snow. I had to go get some friends and get them with shovels to come and help me. And then we split the profits. And that was my first exposure to earning money. And I was like, it was a life-changing experience for me. It started out with just wanting some stupid leather tennis shoes, but I came home that day with a pocket full of money and a whole new lesson in life that I could earn money, that I had something that I could take out into the marketplace. This pudgy, I was a big kid for 10. I was strong and I wasn't afraid of work and I kind of liked it. But what I really liked was having green stuff in my pocket. And I came home at the end of that long day with a whole new identity, with a whole new sense of possibilities, because my dad gave me that shovel and said, go knock on some doors. And I think that's where I decided that, being in sales, I've been in sales most of my life. And that's part of what it means to be in sales. You got to be willing to knock on a door and say, here's the service I can provide for you. And I had to figure out a price. I had to come up with a price that was reasonable. As a 10-year-old, that was a little challenging, but I figured it out. I knocked on the next door and the next door, and I kept on knocking on doors. And that pink shovel represents something that I think is more valuable to you than anything I can teach you. And that's your willingness to go and find something in the marketplace that allows you to create value. And you have different skills than I did. I was just an overweight little kid who had a lot of muscle and a lot of willpower and a snow shovel. But some of you have incredible talents that you could use if you figured out how to do that. And that's what I want to encourage you to do. And that's what the pink shovel is all about. It's my story of how I got into the world of earning a living. Because if you don't do that, if you don't figure out how you can earn a living and earn an income and create value somehow in the marketplace, nothing I teach you about investing is going to be worth anything. You have to have income. You have to be willing to work and to earn. And that means, I think, figuring out a way to create value with your skill, with your talent, with your intention. And when you do that, possibilities change. And so I know most of you are in school and that's your job right now, but I just want to plant that seed and share my story and hope that for a couple of you, it might give you some encouragement to be courageous and go out and ask for the sale, because that's what I did with that silly snow shovel. And then after that, in the summertime or the springtime, It was, hey, you have a garden. Do you need a kid to come and pull weeds out of your garden? And then my dad lent me his lawnmower. And so in the summer, I got to learn how to cut grass using a lawnmower. And then I had to buy another lawnmower because that first one wore out. And then in the fall, it was raking leaves. And so this whole idea of figuring out what did the neighborhood need that I could do and what tools did I need to do it. And the bottom line, though, was being willing to knock on doors, take good care of customers, and deliver the services that they paid me to deliver. And that formula for success, that very basic, simple formula, has really been kind of my whole life story in terms of building wealth. And so I just wanted to share that with you. That's the story behind the pink shovel. So that's pretty much it. I could spend a few minutes to review those buckets, but I'm not going to do that because we're out of time. So the 3 buckets, or actually there's 4 buckets, but those are the buckets, the strategies for types of accounts, the types of accounts that we talked about today, in addition to the 4 investment strategies that are designed to help you maximize returns and minimize risk, coupled with the perfect investment, your 401k. Those are the ideas we talked about today, and you're going to do a little research in your assignment this week. You're going to have a quiz. You're going to learn a little bit more about these types of accounts. And then hopefully you'll have the information that you need to put this into practice and start making some decisions at some point in your life about which types of accounts are you going to choose to build wealth and try to achieve financial freedom in your life. So I hope that's been helpful, and I appreciate your attendance. And I will see you next week next week we're going to do a wrap up. We're going to do the capstone review, and I'm going to prepare you to complete your capstone assignment, and then we're going to wrap it up. We probably will wrap it up a little early. Next week will be our last lesson. So I'll be available to answer any questions you have this week and next week, and prepare you for your final capstone assignment. But this week it's all about types of accounts. So good luck in your studies, and do let me know if you have any challenges or problems, and I'll be happy to help. Thank you much, and have a great day. I'm going to end the broadcast.